Hello and good afternoon, everyone. I hope you are all keeping safe and healthy during these times. Today on the call, I am joined by our CEO, Mr. Rajiv Mehta, Mr. Shashidhar, our CFO, and Devan Dhruva and Neha from Orient Capital, our investor relationship partners. We have uploaded our investors deck, results and highlights on the stock exchanges and the company's website. I hope everyone had an opportunity to go through the same. Q1FY22 started on a positive note, with the company delivering strong performance. Revenues grew by 133%, EBITDA by 110%, and PAT by 734% year on year. Our company delivered a strong performance on the back of stellar volume growth, operational efficiencies, better product mix, and cost rationalization programs. The business would have grown at an even better pace had we not been hampered by the second wave of COVID-19 in the month of May. The second wave of COVID-19 had adversely affected the economy. In these tough times, our priority had been clearly shifted to taking care of our people on ground who were working relentlessly in these challenging times. The company organized vaccination camps at the factories for employees and their families. We also extended the health insurance program for all our employees. 10 commercial-grade large RO water purifiers have been donated and installed at the neighborhood villages of Stovekraft factory in Bangalore. Each RO purifier is sufficient to take care of the drinking water needs of the entire village daily. Also during the second wave, 10 oxygen concentrators have been donated to the Public Health Department of Ramnagara district, where the Stovekraft factory is located. Coming to the quarter, the company introduced 20 SKUs across different segments. We have increased our sales of our high-value premium products, which have helped increase our gross profit margins. During the last quarter, the company launched India's first touch mixer grinder, that is a sensor touch mixer grinder with a 1000-watt motor. It has an anti-shock ABS body and an intuitive touch panel. It is also fitted with surgical-grade stainless steel blades and ergonomically designed handles with a jar locking feature. The company launched a very innovative product, the blender. It is the anytime blender. It is easy to carry and drink straight from the container, easy to power up with a USB cable to the power bank, laptop, etc., and can easily make 20 glasses of smoothies per charge. It has an unbreakable food-grade polycarbonate container and is very easy to clean. Also, the company launched a new range of cast iron cookware series, and which can make dosas. There is dosa tawas, concave tawas, kadai, grill pan, and frying pan. These are naturally non-stick cookware, not coated, but by naturally the way it is made. It's chemical-free, having even distribution of heat. Cooking in these adds iron to your food. These have a longer lifespan too. The company also launched sleek cooktop, which has an impact resistance of glass, non-slippery legs for confident cooking, and very slim design ergonomic knobs with a nice glow. These are unique round-shaped fan supports for extra feel. The company is continuously focused on creating new products to improve the consumer experience. We plan to launch over 30 SKUs in the coming quarter. During the quarter, we have increased our spending on branding and marketing. We believe that continuing to develop awareness of our brands to focus on consistent branding and marketing initiatives is important for our ability to increase our sales volume and our revenue growth, our existing market share, and expand into new markets and new product categories. The digital platform and the social media have enabled us to reach and engage with wider audience and customize business product offerings. The company plans to spend between 3 to 4% of our revenues on branding and marketing. Due to the second wave of COVID-19, there are lockdowns and restrictions announced by majority of the states. The general trade and the modern trade, the large format stores, were closed during May, thereby adversely impacting sales. The business would have performed much better had we not been hampered by the second wave of COVID-19 in this particular month of May. Business resumed to reasonable level post 10th of June. Post the relaxation in lockdown restrictions, the company have been doing well and witnessing robust demand from all channels. The company has shown growth throughout all the channels of distribution during the last quarter. Modern retail, general trade, and e-commerce all grew over 2 times despite May being a tough month. Our focus is on increasing distribution, increasing the network in rural areas, and bringing more customers on board through our increased number of outlets. Our kitchen solutions comprise of cookware and cooking appliances across our brands, and our home solutions comprise of various household utilities, also includes the consumer lighting. This enables us to be a one-stop shop for kitchen and home solutions and offer products at different price points to meet the diverse consumer requirements and aspirations. Our pressure cooker category has had a volume growth of 195%, and this contributes to about 22% of our revenues for Q1. Our non-stick cookware category had a volume growth of 61% and contributes about 25% of our revenues. Our gas and induction cooktop category had a volume growth of 218 and 152% respectively. Collectively, they contribute to 18% of our revenues. The company is focused on own manufacturing. Our trading sales have also reduced considerably during the last few quarters. During the last year, the company incurred a capex of about 63 crores on various building and infrastructure, along with the machines that are required to create this infrastructure for the large growth in the manufacturing contribution of the company. Our manufacturing facilities are backward integrated. We have the ability to manufacture components such as backlight handles, sheet metal components, molded parts, die-cast parts, molds, dies, and fixtures, all within the company's manufacturing facilities. We believe the backward integration of our manufacturing facilities have reduced our dependence on third-party suppliers and OEMs for such components. We have a constant focus on technology application at our facilities, and we believe that this would enable us to achieve greater efficiency in reducing time taken to and for the cost of manufacturing of our products, from design to commercial production, and in-house testing and quality assurance process resulting in higher profit margin. Our endeavor is to keep adding new and innovative products to our portfolio and enhance our addressable market through strengthening the distribution network across domestic and international markets and be a preferred brand for our consumers. We have dedicated in-house R&D facility and have progressively increased our investment in R&D in the last few years. We have installed a 3D printing facility which can give us real-time design insights of the new products that we develop. To further our efforts to innovation, we have also entered into ties with foreign companies for technology enablement and tech know-how agreements. We are continuously looking to improve our distribution network. We have a dedicated distribution network for Pigeon LED, Gilma, and Black & Decker. We have also been able to leverage the distribution network for Pigeon branded products and their brand recall value to enter new product segments in the markets. We strive to ensure the quality of products is complemented by after-sales service provided to our consumers across segments through a dedicated centralized CRM and a large team of in-house service personnel to cater to the requirements of our consumers. We have implemented a distribution management system which helps the organization to track secondary and tertiary sales and maintain inventory levels at the distributor's center. This also gives us visibility to the secondary billing happening from our distributor to the retailer. With a constant focus on technology application and increasing the level of automation, the company plans to achieve greater efficiencies and cost reduction, resulting in operational efficiency and higher profit margins on a sustainable basis. With this, we now are open to the floor for any questions and answers. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1. The first question is on the line of Kondanya Nimmagadda from JM Financial. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just a bookkeeping question. Can you help me understand what is the A&P spend for the quarter?
Not a big spend.
advertising and promotions?
So generally, we plan to spend about 3% of our revenues, which would have actually been around 6.5 crores, but we could only spend 5 crores.
How much, sir? Sorry, I missed the number.
5 crores.
5 crores is the number you spent in the quarter. Sir, otherwise, other than the A&P spend, what are the heads where we saw a reduction or significant increase vis-a-vis last quarter?
Yeah, our cost on transport, that is outward freight, which is a cost to the company, in percentage terms have come down, is now below 3%, which is far better than the industry, and it used to be higher for us also.
And where do we see sustaining, sir?
In the finance cost, because most of our debt is retired, and just for the discounting that we incur for our channel partners, both the suppliers and the customers. Otherwise, more or less, the finance cost has come down to almost nothing. So these two are the major savings.
Okay. Sir, this outward freight cost, you said it's below 3%. Do we see it sustaining at the same level going ahead as well?
Yeah, we still see there is a scope for some 100 basis points. So still there is a possibility that we improve on this, but I think the company has done very well on the cost of outward freight.
Understood. Sir, what is the debt on books as of June 30th of June? And also if you can comment on working capital.
Around 15 crores.
So it has remained flat QOQ?
Around 15 crores.
Yeah, I think that's the same number at the end of March, I think.
Yeah. There have been some capex investments that we've been doing, and the first quarter generally is a soft quarter. It's the nature of the business, and so the monies that were generated were also invested in various capex, ongoing capex.
What is the capex amount, sir, if I may ask you?
For the
first quarter,
the last quarter?
Yeah.
It's an ongoing thing, but I can tell you it's in the range of 10 crores.
10 crores, understood. Sir, can you comment a little bit on the working capital levels with the company and also the inventory levels with the channel, and how is it shaping up with all the lockdowns and everything that has happened in the quarter? Yeah,
particularly in the last quarter, because the markets were all closed. The general trade markets and the modern retail stores were closed. There was a little bump up in the inventory, but that is already getting back to that normal levels, because we are having very robust demand from all the channels. So there's not too much of currently it is not the inventory levels are the normal levels that we aspire to. So currently we are at about 35 days on inventory, and also we are below 30 days on receivables.
And where are we on payables, sir?
Payables, we would want to be at 60, and we are there.
Understood. And how is the channel inventory levels currently?
Come back?
I was asking about the channel inventory with trade. No,
I think I mentioned in my call that we have implemented a DMS, and we continuously monitor the inventory levels at our distributors. So it is a very healthy level, and it's only to cater to the requirement of our demand that is there from the consumers.
Thank you, Mr. Kondunya. Request you to join the queue for any follow-up. Also, participants are requested to limit their question to 2 per participant. If time permits, you may join the queue for any follow-up. The next question is from the line of Vipin Goyal from Mirabilis. Please go ahead.
Yeah, hi sir. Thank you for the opportunity. Sir, just this question on the trade mix. So if you can comment on what's the current trade mix for us in terms of general trade, modern trade, and e-com, and then also on the margins for these trades. So how do the margins shape up for these trades?
I'll come to the breakup of
For the quarter, if you look at the quarter, because May and the first couple of weeks of June was practically a lockdown, the contribution from general trade, which includes Pigeon and Pigeon LED, was about 30%, and e-commerce was close to 40%, 45%. General trade and e-commerce. We had modern retail, again, a large part of it was closed. but modern retail contributed about 8%. Then we had export. Export contributed close to 15%. So that was the mix in terms of the channel split.
Okay, and how is it generally lined up? I mean, this was in the first quarter, so usually, like if I had to talk about FY21, so how was this? How do we see this mix?
Spike in exports.
Yeah. So we just saw a spike in export and e-commerce because of the lockdown. The other two, which is modern retail and general trade, were not able to. E-commerce was on its normal course of business. We had a spike in export, so hence contribution of export as a percentage of revenue was higher in this quarter, which is the first quarter of FY22.
Okay, all right. And then so this last one on the pricing. So since this commodity upcycle since last year, what's the price hike that we have taken across the product categories? And if within that product category, if you can just give some clarity on what all products, in which category we have taken what's the price hike?
So our pricing is actually on a cost plus level. What we do is we know what is our landed cost, and on that we add our markup so that we can retain our gross margin. And that markup is constant for all products and across all channels. So our margins are channel agnostic and our margins are also product agnostic. So for example, if something is 100, I do a markup on that and that becomes my selling price. It's called the minimum realization to the company. In order to pass on the price, because we are a cost plus company, the price increases are passed on, and we have an opportunity at every quarter to do a price correction or a price revision. There will always be a certain amount of inventory in terms of raw material which will be at the starting of the quarter, and that correction follows there is a certain amount of lag. So at every quarter beginning we do a price increase. In last November 2020 we did an increment of average 4%. In April of 2021 we did an increment of 4%. And going forward, depending on the price increase of raw materials, we take a call at the beginning of the quarter whether to pass it on or not.
Okay, so as of now, the price increase, the change in raw material has been factored in.
Yes, it's been neutral.
Okay, all right, sir. That's it from my side. Thank you.
Thank you.
Thank you. The next question is from the line of Mayank Bhandari from Nirmal Bang. Please go ahead.
Yeah, thanks for the opportunity, sir. Sir, as we have seen in this quarter, non-stick cookware is contributing almost about 25%, which was about 18% in Q4. Sir, can you give a corresponding figure for Q1FY20 or maybe for the full year 20? What was the contribution for non-stick cookware?
So the spike in contribution only, while for us all the products are growing at the similar rate, the spike in contribution is being high because of the higher contribution of exports in the revenue. Because we had lost some revenue from the general trade and the modern retail. The overall revenue otherwise would have been little higher. So that is why you see a little higher contribution, that is 25% of non-stick cookware. Yeah, if you wanted that number for FY20, we were at 21 crores and this is at 30 crores now.
21 crore for FY20?
I'm sorry, FY21 we were at 30 crores and we are at 67 crores for FY22.
Okay, so that is non-stick cookware.
Yeah, it's the non-stick cookware.
The revenue number?
Revenue number of non-stick cookware in the quarter FY21, first quarter of FY21, we were at about 30 crores. And at this corresponding same period, that is a quarter that ended in FY22, we were at 67 crores.
So extended to that, sir, for the full year, as my export is now increased to 15% of total revenue, for the full year, it is expected to be around that, FY22?
No, so while the export is also, of course, growing, we don't expect it to be at 15%. For the first quarter, the contribution from export was higher because the channel was open. We were allowed to manufacture and export, whereas the general trade and the modern retail were not. So we believe that, but for 1 or 2 percentage, between 13 and 14% is what we expect that this year we should end up on exports.
Okay. And sir, I just wanted to understand from how e-commerce revenue is behaving. Like you had said that 30% of revenue had come from e-commerce. So within month-wise, like let's say there was lockdown in May month, so the contribution in May month would have been higher from e-commerce, and now as in July month the contribution would have been lower. So it's just to that I want to understand the trend, that whether with the unlocking, whether the e-commerce is going down, or how is the consumer behaving in terms of buying from e-commerce?
No, the e-commerce channel is actually there is no change in the contribution from e-commerce as a channel, but it is higher in the terms of contribution because of the reduced contribution from other channels during the first quarter, and the e-commerce also goes through various. There are weaker first quarter, then there is a season in the second quarter. So actually, the second quarter will be higher in terms of the overall revenue number for the e-commerce. But on the contribution, I can say actually it is growing at the same way at the levels that we have anticipated, and only for the quarter there seems to be a little from e-commerce because of the subdued contribution from general trade. But post June 10th, I can tell all the channels are doing extremely well.
No, sir. My question was that with the unlocking and with movement starting.
So the e-commerce channels continue to contribute. They continue to grow. That's what I wanted to convey.
Okay.
It's not that just because the lockdown is, there is a normal situation in the general trade. It is not that the e-commerce is contribution. The revenues are reducing. No, they are still growing.
Thank you. Mr. Bandani, request you to join the queue for any follow-up. The next question is from the line of Amit Mahawar from Edelweiss Securities. Also, participants are requested to limit your question to 2 per participant.
Thank you. Mr. Gandhi, the entire team, congratulations on recent results, both on growth and profitability. Sir, I have 3 quick questions, or maybe I'll club them into 2. First is, what is the growth in product that are launched before 1 year? So old product range, what is the growth that we have in this quarter? And correspondingly, what is the e-commerce market share right now we have? That's the first question. Second is a particular question on digital visibility. The entire team that we have, what is your plan, on ramping up the digital presence? Dominant market share is something which we already have, but something beyond that in terms of comprehensive approach to digital marketing, what are our plans? Thank you.
So you are particular about the growth on the various product categories. When we say we introduce product, but they're all classified either in the cookware segment or the cooktop segment or the appliance segment. So for us, these 3 segments, as I had mentioned to you about the percentage contribution and also the growth, they've been very, very high. And we continue to grow in all the 3 categories. That is the cookware category. When the new products that are launched are only a subcategory of the same segment. So there will be a new range of cookware that is being launched. That is the cast iron cookery, which was never there in our offerings, is now a new variety that we are launching. So they are both the existing range and the new ranges are contributing. It's not that the growth is coming only from the new categories. They are yet to stabilize and see the future. But the existing categories are also growing. So all of these 3 categories, the cooktop, I had mentioned to you that we had the kind of growth we had both on induction cooktop and gas cooktop. And on the pressure cooker and the non-stick cookware, I've also mentioned to you the kind of growth in terms of both volume and value growth.
Maybe, sir, maybe I'll rephrase it just for the ease. Maybe what is the revenue contribution of the last product launch in last 6 months, particularly in this quarter? Maybe that's the specific question.
I think we'll not have exact numbers right away, but
okay.
Immediately we can share it with you.
No problem, sir. Fair point.
On the digital marketing, of course, like you said, we are prominent in both Cloudtail, which is Amazon, as well as on Flipkart. Having said that, we have a team which is constantly working on Amazon, both on the keyword search marketing, which is CPC, as well as CPM, where we buy the banners and we optimize it ourselves. We make sure that there is a certain amount of cost benefit that is happening on an ROI basis. So we are increasing our spend on digital. I would say that a significant spend compared to last year, this year in marketing will be through digital media. We have also started engaging with influencers. We have amped up our presence on social media, which was less compared to this first quarter last year. And same with Flipkart. We are working with the Flipkart team. Flipkart has a portal similar to Amazon where you can put your own money and you can monitor the progress of all your digital marketing. So marketing efforts on the digital front, both in social media and on the platforms, is being amped up this year.
Sure. Thank you.
Thank you. The next question is from the line of Samir Palod from AUM Fund Advisors. Please go ahead.
Hello.
Please go ahead, sir.
Hi, sir. Congrats on a good set of numbers. So, with the trading business, reducing drastically, what kind of margin profile will we see going ahead?
Obviously, the contribution from our manufactured products, because when we get into manufacturing, there are two phases. First, we start manufacturing any product with a scale. That is, we set up assembly lines. And as we set up assembly lines, there is a cost reduction, and obviously we see growth in the numbers. And when we get substantial growth, then we backward integrate. Both these initiatives end up in reducing our cost. We pass on a majority of that. I can say 75% of that cost benefit we pass on to the consumer. So there is a residue number that contributes. Obviously, with the growth in contribution from manufactured versus traded, I can say there will be definitely improvement in the gross margin. There is a improvement in gross margin.
On the EBITDA level, can we say that we can do upwards of 15% EBITDA margins once we are completely out of the trading business and in a normalized year?
So it's not that we will be completely out of trading business, never, because the strategy will always be to first introduce new products. The initial route will be trading, and we continuously keep on adding new products, and then subsequently get into. Yeah, that is. I think we are heading towards that 15%.
Okay. And sir, what kind of capacities do we have in terms of gross block, and do we need further capex to grow more, or do we have enough capacities to scale up our revenues or double our revenues in the next 3 years?
The last year we have already started this expansion, and we have invested close to 63 crores on the various requirements like building new sheds and several lines we have added, and also backward integrated on several of the products. I can say the process is already on, and it will culminate into expansion of our capacities from what used to be. I can say by the end of this year, we'll almost be adding 50-60% additional capacity in all the categories. We are expanding on the non-stick cookware. We are added capacities on our pressure cookers, and also the small appliances. We have a complete new factory, a multi-level factory. First time in Stovekraft, always we used to have a single level, but it's a multi-level factory for the small appliances that we are getting into manufacturing. So all these three categories we have invested, and including the induction cooktop, we have expanded our capacities. We used to consider ourselves that we had a capacity of between 1,000 and 1,200 crores. But with the new additions, we see the revenue can actually, at the full capacity, we can get to 1,800, 2,000 crores.
Okay. Thank you, sir.
Thank you. The next question is from the line of Deepak Lalwani from Unifi Capital. Please go ahead.
Hi, sir. Thank you for the opportunity and congrats on a good set of numbers. So what is the current export order book status? Previous quarter you had indicated 130 crores for FY22.
Yeah, we actually have capped for this year. Even before the beginning of the quarter, we were full with the order. We are at the same number or little higher, and we would want to develop new customers this year, but not not for the revenue, but for the future, for the next year. This is only for the year. We are targeting between 130 and 150 crores, and the order book is already full.
Okay, so with the improved visibility that you have, so what is the kind of number that you're looking for FY23? So can we expect somewhere around 200?
So I believe for a few years, the kind of demand that is being witnessed at Stovekraft, we will grow at not less than 50%, but it could be little higher on the export.
Okay. Thank you, sir. And sir, on our margins profile, this quarter it was low on account of lower sales. So what will be our full year guidance on the EBITDA margins?
We will be better or at the level of last year. We can be better. See, it's a function of the revenue. Beyond the break-even point, substantial portion of that gross margin flows to our EBITDA. Obviously, I can say we were at about 70-75% of our aspired number, but of course, which is all explained about the lockdown and all that. But post June 10th, I can say we are experiencing robust demand. We are able to both produce and sell. On both sides, we are seeing very good traction. So we'll be at the level, in terms of percentage margin, we'll be at the level of last year, or I can say there'll be an increment.
Got it, sir. That's helpful. So, as the demand has picked up in the domestic business, so what kind of growth do we expect for FY22 and 23?
So the company has been growing. We are growing between 15 and 25%, but the current times, in spite of that huge setback that was there in the first quarter, we have done well because the similar period last year was also a very bad period, even worse than what it was this year. So if there is no lockdown kind of a situation, we will be at the higher end of this growth. We can definitely expect a growth of upwards of 25%.
Okay, so 15% for the domestic business, right?
No, I said about 25%.
20. Okay, sir. Thank you, sir. That is helpful. All the best.
Thank you. The next question is from the line of Nikhil Gara from Abacus AIF. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. So my first question is that in the press release you have mentioned that we have seen a gross margin improvement due to higher sales of value products, as in premium products. Is this in the Pigeon brand that we have created some premium products, or is it the Gilma and Black & Decker?
So when I say that is by features, we are clearly targeting our TG. We are focused on the target segment that we believe that we belong to or aspired by, and but this TG is also evolving, and so we want to continuously excite them with higher end features. But the consumers are actually more and more consumers are directly themselves involved in cooking and celebrating in the kitchen now. So because they are involved in that, they are also they are getting excited with new features and better product offerings. So at the higher end, within the range that we offer in the Pigeon brand, we are seeing that the categories which are relatively premium to the brand are seeing higher traction.
And sir, what would be the share of this? Any quantitative number?
We are not exactly done an analysis. I think we'll do this now. Start doing this.
Sure. And can you at least give the gross margin difference in these products compared to our base?
No, honestly, for us it's not very big. But of course, at the premium end, we get our full margin. I mean, there is no compromise on that. So the difference will be there, but it's not very substantial. It is a 1 or 2%.
Okay, sure, sir. So my second question is, when we also look at the peer numbers, we have definitely done better than them. Could it be because our e-commerce presence is, comparatively better, that has helped us? And another question regarding this, can you quantify how much sales we would have lost because general trade was not operational?
So I'll tell you, the June month we could recover more or less. May was almost shut. So the revenues that are there, majority of the revenue is only from non-general trade and modern retail outlets. So that is the revenue for the month from these two channels. You can add to that number that we would have lost. If you want me to put that number, it will be between 30 and 40 crores.
30 and 40 crores. Got it, sir. And so just lastly, you said that we are planning to increase our A&P spends. I guess, if I'm not wrong, our FY21 was close to 3%. How much do you plan, 3% of sales, how much do you plan this to go up by for FY22? And
so we would see there is an increased revenue number for the current year. And then between 3 and 4%, it cannot be very specific. So we look at opportunities where we can rightly invest on the marketing and the advertising. So we would want to be in the range of 3 to 4%.
And it would not strain our margins, as in the margins will still be.
So I will tell you, it's a function of the revenue, and the contributory margin also goes up. And when the contribution margin goes up, and then from that, even if you are spending 1% more towards advertising, at the EBITDA level, it neutralizes or still there is still room.
Sure, sir. Thank you so much, sir. Thank you so much.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investments. Please go ahead.
Sir, I missed the comment on how much growth do you see in FY22. Did you mention 25% as the company level top line growth?
Of course, I think I don't know whether it was fair of me to have told you this number, but anyway, since I've already mentioned, yes, you can expect a 25%.
Okay. Thank you, sir. All the best to you. Thank you.
Thank you. The next question is from the line of Aditya Mehta from GK Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. Sir, just want to understand that what are our longer term plans with regards to 3 or 5 years plan. For current year, we are given guidance of 25%. So what is it which is helping us to grow so fast? Is it that the whole industry is going with such pace, or there are some strategic decisions that we have taken or areas which we are working on, which is helping us to grow?
It is our position of the brand. The country and the position are in sync, and the opportunities that are there in the country. I tell you, more and more of manufacturing is going to help. Our strength of our company are basically these three. We believe that manufacturing is our strength, and in the branded space, the companies that operate here, the maximum contribution of our revenue is coming from manufacturing. It's further, we are investing further on this. That is our capability and strength, which brings the cost at, actually the margins are both of manufacturing and the marketing are in one company. And we have a very, lower aspiration on the margin. It's not that our products are we don't have a very high gross margin. So we operate at about 35%, which is at the lower end for the peer group. And with that margin, we are able to get to an EBITDA level which is at par or better than the peer group. So that is on the margin side. On the growth side, because we are in a segment which is the largest segment in the country, the aspiring class, and all our products are actually targeted to a larger customer base. And because also this consumer base is growing faster, their capability to buy, that is the disposable incomes of this class of customer is growing. Obviously, because we are catering to them, it's the largest consumer base, and our capability to continuously excite them and deliver meet the demand. Both these are helping us to grow at higher than that. We believe that unless there is some disruption for a long time to come, the strategy of the company and the strength of the company will help it to grow at higher than the industry.
Okay, that's very helpful, sir. Thank you. And so just one more thing, just if we deduct our promotional expenses from our revenue numbers, right? So if we adjust them back, so what will be our gross margins then?
Okay. Sorry, can you please repeat?
We deduct promotional expenses from our top line numbers.
Yeah.
Is that correct?
Generally, it is about 4 to 5%. There will be various promotional spend. What I mean by promotional spend is incentivizing the channel, incentivizing the sales. So whatever goes into incentivizing this, we call it as promotional spend. We net it off from our revenues.
Okay, so if we add them back, then the gross margins will be around the 40% odd levels, right?
Yeah, close to yes.
Oh, okay. And so what was the investment which was done for increase in capacity, about 50-60% in capacity increase?
I think it is close to 63 crores so far that we invested in the last year.
So 63 crores will help us give what type of revenue number? What will be the
ongoing thing? This was already invested, and once the investment is done, because we are investing in all the categories, so it will take us to at least 1.5 times, 1.6 times our existing capacity, which we believe will take us to around 1,800 to 2,000 crores.
Okay, sir. Okay, thank you. That's it from my side.
Thank you. The next question is from the line of Rasmik Oza from Kotak Securities. Please go ahead.
Yeah, thanks for the opportunity, sir. I understand this 1,800,000 crore target we're looking at. Will it be achieved by FY24 or much before that, or it will be FY25?
You're talking about the capacity or the revenue?
No, the revenue. You said that based on the additional capacity, you are aiming for around 1,800.
When we build capacity is not that every time. The capacities are always built for the future, and of course, it's not that every time. It's a uniform revenue month around the year. So for the peak is what it is built, and we'll not be able to utilize 100% around the year. And the revenues will be obviously a little lower than the capacity.
Okay. Thanks.
And we still have room for traded goods. All this that I was mentioning is about the manufacturing. Within the company or within the business itself, I tell you, it is little cyclical. It is for the nature of the business that we are. The first and the last quarter generally contributes about 40%, and the second and the third quarter generally contributes to 60%. So there is a skew in the requirement also. So the manufacturing and the revenue, that is the sales, I cannot go only in tandem. We cannot, as a manufacturing company, it's not that we simply produce and keep. We believe that we should be as thin as possible in our inventory, and so we will only manufacture based on demand, but for maybe sometimes a little here and there. So the capacities that are built are actually for the peak, to satisfy the peak also.
Okay. And so going forward, what could be the asset turnover ratio we should look forward? Will it be 3.5 times or 4 times?
I didn't understand. Can you repeat?
The asset turnover ratio. Like for example, to reach this 1,800.
For us, it's very important that we do at least 4 times.
Okay, that is helpful, sir. Thank you so much.
Thank you. The next question is from the line of Ashish Kumar from Infinity Alternatives. Please go ahead.
Hello.
Yeah, Ashish, go ahead, please.
Yeah, Priyam here. So, sir, just wanted to understand with regards to your export business, you're talking about 130 to 140 crore export business this year. Going forward over the next 3 years, where can we see this business in terms of revenue?
So we see that it will grow higher than the company's growth rate, the export business for at least the next few years.
Okay.
We are at about 13 to 15%, between 13 and 15% of our revenue. We believe we should stabilize for this year at between 13 and 14%. But in the next 2-3 years, definitely because of the higher growth rate, this is moving towards the 20%.
Okay, so if we expect the 25% revenue growth at a company level, is it safe to assume that our export will be growing in excess of 35-40% and we'll reach around a 300 crore export turnover?
So actually, we also want the growth at the right pace. So the opportunity is higher than what we are catering to. At least 50% growth rate for exports is what we are seeing in the next at least 2 years. The visibility is there.
Okay. And just on the margins for the export business, is it similar to the company level, like 13%-14%, which we are reporting right now, or is it lower?
At the EBITDA level, yes. Yeah, not at the gross margin, but at the EBITDA level, yes. Because we have very few costs after the gross margin. At the EBITDA level, it is either at the same level or even better.
Okay. Thank you. That's all from my side.
Thank you. The next question is from the line of Nilesh Chitani from Envision Capital. Please go ahead.
Hi, sir. Thanks for the opportunity and congratulations on the great set of numbers. So my first question, it's a bookkeeping question. Wanted to understand what is our current share from the e-com business in terms of percentage.
So if you look at only the first quarter, then it will be skewed. It will be close to 45%. But for the year, we expect it to be at about 30%, between 30 to 35%.
Okay. So second thing I wanted to understand, since our share from the e-com business is quite higher, so what it takes to sell higher in the e-com platforms? Is it the price differentiation or is the brand recall value, at least for the product categories in which we are available? Any sense on that?
If you Pigeon is a value proposition. We are addressing to the population, the bottom of the pyramid, as you can say, and that is where the lifestyle is changing. People, even in the rural areas, are modernizing. As a result of which, it is helping us cater to new and people who are coming onto the e-commerce. The second part is that we were already present in e-commerce before anyone else came. We had the early mover advantage. Way back in 2016, we started our e-commerce journey with both Flipkart and Amazon. And third, of course, we have the top quality product at an unbeatable price. So as a result of which, these two have yielded us with high number of ratings and high ratings itself. So if you look at our pressure cooker, or if you look at our non-stick cookware, or if you look at our choppers, we will have a rating. The number of ratings will be in lakh, and the rating itself will be 4+. So these three, early mover advantage, top quality at an unbeatable price, and of course rating, helps us capitalize on the e-commerce opportunity.
Understood, sir. So my next question was on the growth outlook. So when we talk about aspirational asset turnover, it's in the range of 4x. Our current gross block is in the range of 220 to 250 crores, and we did around 860 crores revenue last year. Even if I take a 25% growth, we would be at around 1100 crores of revenue for FY22. So at 225, 250 crores of gross block, how can we have that 4x optimal level of asset turnover? Or either the purchase contribution would be higher, or that will drag the margins for FY22. Just wanted to have a sense on that.
So for us, there is a thumb rule that we apply also, and for the capex to contribute, it is there will always be a little lag, 1 or 2 quarters. It has to start generating revenue. There is a time when you invest, and there is a time when it starts paying, working. Otherwise, the thumb rule that we apply is that it has to give us minimum 4x.
I'm talking about the current situation. So as of FY21, our gross block would be in the range of 250 crores, and revenue were around 860 crores. So aspiration of having 1100 crores kind of a revenue in FY22. So our current existing capacity would be able to support that kind of numbers. I'm asking that.
Yeah. So you'll have to understand that the company has already invested on land which can pay. All the land that we currently have can take care of all the expansion plans for the next 5 years. So this investment was already done. It is only that we build new sheds and set up lines. So unless you do very large backward integration for the normal front end investment, the minimum that we apply is it should deliver a 4x revenue, and we are very confident.
Thank you, Mr. Jitani. Request to join the queue for any follow-up. We have the next question from the line of Abhishek Maheshwari from Skyridge Wealth Management. Please go ahead.
Hi, sir. Thank you for taking my question. I have only one question. So these products that we are launching at Onam Festival, are these companies' own manufactured products, or will this include trading products also?
So yeah, majority of them are our own production, but there are some products that we are launching, and once there is scale, we'll get into manufacturing.
Okay. And so, sir, in these manufactured products, these supply chains are domestically sourced only, or we are importing the components from different countries?
Supply chain for domestic products, we are largely backward integrated for most products. There is a very limited amount of dependence on anything which is imported, one of them being the glass for the gas cooktop. So largely we are backward integrated, as a result of which most of our domestic products are completely made in-house.
Okay, sir. Thank you very much. That's all.
Thank you. The next question is from the line of Nikhil from SIMPL. Please go ahead.
Yeah, hi. Good afternoon. Hello, am I audible? Yeah, hi. Good afternoon. Congratulations on great set of numbers. Sir, as you mentioned that our brand is currently focusing on the bottom of pyramid, and there is a big change in the lifestyle. Just want to understand on the premium side, on Black & Decker and Gilma, how are we thinking about? And I don't know if you share the revenue contribution from those brands, and over next 3-5 years, what are the plans over there? That is one.
Yeah, these are totally different, offering to different set of customers. We are targeting different customers, and the strategies for these are also different. Today, the contribution of these two brands is relatively very, very small, is in the range of 5 to 6%. But because of the smaller base, they are growing. I mean, the growth rates are higher. Of course, since they are addressing a different class of customers, the offerings are also different. The strategies are also different. Gilma brand, we operate only through our exclusive outlets. We have EBO stores, and we plan to now ramp up this right now, expanding initially from the south, but we want to take these stores across the country. Currently, we are in the range of 70 stores, but already post the lockdown period, we have started working on this, and very soon, quarter on quarter, we'll see number of Gilma stores growing. On the because it's a premium end, and most of the products are currently sourced. We import them from most of them come from China. We had a lot of challenges because of the smaller quantity of product. I mean, in the number of pieces that we import, there was a supply chain disruption even in China, and so for the recent past, we are on the supply side rather than the demand side. But we have addressed this, and we are improving the offerings also. There is a process of getting these approvals of these products, which takes a reasonable time, 6 to 8 months of process. As the range grows and the supply chain, this will also grow. So I can say that there is opportunity for high growth in terms of contribution to the revenue.
Okay. And secondly, sir, this was in respect to a question which was earlier asked, that if you look at the new product launches which we have done, so it can be around two segments. One is entering new segments, and another is providing new SKUs or innovative products. So if you have to understand, say, on a cumulative 3-5 years, the number of products we would have launched, how would that breakup be between new categories which we have entered and new innovations? And going forward, would you see that we would more consolidate in our existing categories with own manufacturing and everything? Or how do you plan out in terms of new categories and new products, new SKU launches and all?
So I want to again guide you through this. We are in the segment. These are the segments that we operate in, whether it is the cookware or the cooktop or the kitchen appliances, mostly in the kitchen, and then there are some utilities in the home segment. The segment is the same. The innovation within this segment is a continuous process, and within the product segment that we offer also. So there could be a new variant of a mixer grinder, but there is a completely different variant, which is the blender. So this is not a product that was existing, but it is an offshoot of the mixer grinder. So there are products that there was never a chopper in the kitchen, but then today we have a huge offering in the chopper category, and then the innovation goes on, and we come with a complete food processor on the lines of the chopper. So the categories are the same. We in the last few years, we have not seen any category which is not done well. And the moment we see volumes picking up in any of these products, then of course we get into manufacturing. When we get into manufacturing, we rationalize the number of SKUs. We then want to focus on limited SKUs which are doing very well. We would want to do a 80-20 kind of arrangement, analysis. We would want to focus on the 80% and probably let go the 20%. So that's what we do.
Okay, and last question from my side. I just want to understand this trading business which you mentioned in the call that is reducing. So is it like so what I intuitively think, this should be a low gross margin business which will be pulling the overall margin. So what is this trading business, and by when do you think it will be below like 5-10%, and what would be the core gross margin of our manufacturing business?
So let me explain to you what we were. In the past, we were at 30-70. The 30% of the revenues were contributed by our trading products. But we have, in the last 2 years particularly, we have moved a lot of this to manufacturing. But the trading will continue. The new innovation that is happening globally, we will want to bring them to our consumers, and we'll want to import them and then offer it to the consumers. Of course, that will be a kind of a trading activity. But as and when we see that volume growing and acceptability of these products, we will then get into manufacturing. So it's not that it is very low. Of course, there is a difference in the contributing margin. The contribution from our manufacturing products is a little higher than the trading products.
Thank you. The next question is from the line of Pritesh Chheda from Lucky Investment. Please go ahead.
Sir, what would be your net working capital cycle, and do you see any improvement there as we scale up the business?
Currently, we are at about 27 days. We want to make it zero. When I say zero, we would want to move to a complete, actually link to revenue. Today, we are already at 60 days of payable. We want to link it to revenue. So it will be a little higher. And then on the inventory and the receivable, we want to move to the 60. So we want to net off these two, that is the total payable and the total inventory and receivable to be at the same level. Currently, it is at 27 days.
So I couldn't comprehend. So if you could give, then what is the debtor, payable, and the inventory days?
So currently the inventories are little higher for the last quarter because of the lockdown situation. Otherwise, it used to be in the range of 38-40 days, which we want to bring it down to 30. But for the last quarter, it was 75 days. Payable, we want to be at 60, is at 66 days, and debtor is at 36 days.
Okay. And the corresponding debt in our balance sheet is now zero, or we have a net cash positive?
We are at about 15 crores of debt.
15 crores. Okay. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Rajendra Gandhi for closing comments. Thank you, and over to you, sir.
Thank you, each one of you, for joining us. I hope we have been able to answer all your queries. We look forward to such interactions in the future. Once again, I would once again thank the entire investor community for the tremendous support shown during our IPO. We hope to live up to your expectations. In case you require any further details, you may please contact us or our partners, investor relationship partners, the Orient Capital. We'll be more than happy to answer. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Stovekraft Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.